Thanks for attending Sterling Trading Tech's first webinar. My name is Brian Saldin. I'm the Senior Product Manager for Risk and Margin. I'm joined by Tatiana Maximenko, who is our Director of Risk and Analytics. And together we own the Risk and Margin system at Sterling. The Sterling Risk and Margin system was built as a service-based solution. And so what does that mean for you? Well, number one, it means an easy implementation. We really just need your starter date equity, starter date positions, and then execution drops throughout the day so that we can compute your account values. We have all our own market data, and we have an extremely extensive asset coverage. We have US and international equities, options, futures, options on futures, as well as FX and crypto. And we're also adding support for fixed income and mutual funds as we speak. So you'll see that in the risk and margin system shortly. It's a real-time system. So again, we have all real-time market data. We also have your current position. So you can always see your real-time exposure. We have a GUI and an API for both input and output data. So you can give us your input data through API, and you can also extract the risk analytics through API. You can use our web-based GUI. That's what Tatiana is going to demo shortly here. So it's a really flexible system that allows a lot of customization for your individual firm. One of the things that makes Sterling Risk and Margin unique is that we have a robust solution for both risk and margin in one platform. When you think about Reg T or portfolio margin requirements, they're really just a baseline. And FINRA, and of course your firm, is going to expect you to be able to manage risk in a more robust way. And that's where house policy generally comes into play. We have a house policy builder that lets you have your own individual customizations built in to the system so that risk can inform margin. So think about scenarios like a macro crash scenario. Or maybe we're trying to find a concentrated position and apply a higher requirement there. Maybe you have concentration in a particular sector or industry and you need a way to identify that. And finally, maybe a correlation type of scenario where you have 3 or 5 or 10 particular securities or underliers where you may have significant risk, and you need to identify those 3 and again apply a higher requirement. Risk managers, of course, need to control for other factors such as higher volatility stocks, low liquidity underliers, and low market cap securities. And of course, if you have option trading at your firm, you need to be able to control for vega risk too, and not just moves in the underlier. That's where this concept of scenario analysis and stress tests becomes so important. In option portfolios, of course, what we see at a particular stress point doesn't inform any other stress point. So for example, just because I know that at down 10%, a position loses $1 million, doesn't mean I can extrapolate and say at down 30%, it loses $3 million. There could be considerable convexity in your portfolios, and you need to be able to do multiple stress tests and complete scenario analysis to identify what the risk is in your portfolios. Sterling Risk and Margin gives you a really customizable way to do that. So now I'm going to hand it over to Tatiana. She's going to go through a short demo of Risk and Margin, and then our house policy builder and how that can be configured to allow risk to inform margin.
Okay. Thank you, Brian. Hello, everyone. Thanks for joining our webinar. Now I will start sharing my screen and we will all go over the demo of the actual GUI. Okay. So I hope you can all see the screen. So you can see that the web page srm.sterlingtradingtech.com. SRM stands for Sterling Risk and Margin. So this is our GUI. as a client, you would not need to install anything. You can access this anywhere where you have internet access. You don't need VPN, nothing to download, no VPN. You can access it literally anywhere with the internet connection. And before we log in and look at some specific screens, just a few words. So a typical customer setup on this system is that we will set up customers' accounts on our side. Customer will provide us the start of day positions and start of day balances in the morning. Typically, it's done in the form of a start of day file. Sometimes it's done through the API. And then throughout the day, customer will provide position updates in near real time. Typically, it's done through fixed drops, but can also be done through the API. That way, our system throughout the day knows current positions in customer accounts, and then we provide various calculations, which we'll be showing you in a minute, for those current positions using current market data. We have real-time market data feeds from various providers for, equities, options, futures, options on futures, and other asset classes soon to join that list. And so our system provides throughout the day near real-time calculations using real-time market data for current positions. Everything that we'll be showing you on the GUI, or most of it, I would say 95% of it, is also available through API. So customer can use our GUI screens only, or API only, or some combination of two. What we typically see is that it's a combination of the both. There will be a team monitoring the system throughout the day using our GUI, and the customer will also periodically make API calls, extracting various calculation results from us that they subsequently feed into their internal systems, for other users. So now let's log in and take a look. So I'm logging in with my username, and I will show you a few demo accounts that we populated with positions, and it will look pretty representative of how things look for a real customer. It's just that these are demo accounts. Positions will not be updating throughout the day. And also, I just have, less than 10 accounts, whereas a real client would have tens or hundreds or thousands of accounts on this GUI. So here we logged in. We see the landing page. This is just some general market-related information. The main pages of interest are here on the left-hand side in the menu. You can see that we have a lot of different functionalities. We will not have time to go over everything. We'll talk a little bit about risk, then a little bit about margin, and then the house policies, our risk-based house policies, as Brian was explaining earlier. So the main page for risk is going to be under market risk shocks. When we open this page, we see that there are 7 accounts here on the left-hand side, and in each row, there are various calculations for each account. So these calculations are for the portfolio in each account, for the positions. To see which positions are actually in this Sterling demo account 1, you can expand it. You will see that this is the different underlines in which this account has positions. Then you can further expand the underline and see exactly what instrument is there and what's the quantity. So in symbol BA, this account has 200 shares of stock, but in this symbol BXSL, it has 1 option position, short 42, and so on and so forth. So by expanding like this, you can actually see the positions and their quantities. But we will roll it back up, and we will just focus on account level numbers. So what do we have here? As we scroll to the right, we see that for each account, we have start of day equity, which is typically collected from the start of day file in the morning. But again, some clients provide it through API. We have intraday P&L. This is what we calculate ourselves using current market data and information on customers' overnight positions and intraday updates, the trades. So this updates throughout the day. Then current equity is the sum of start of day and P&L. Then, as you can see, we calculate, exposure numbers, market values, portfolio Greeks, and then here towards the end, we have our risk shocks. So risk shocks are those market scenarios, and essentially they are the core of our system. So let's, for example, look at the first risk shock, minus 15, parallel 50. So this is a market scenario. You can think of this as a 9/11 type scenario. So in this scenario, we will shock all underlyings 15% down in parallel. So all underlyings, be it, SPY or, Pfizer or NVIDIA, everything is shocked down 15%. So if stock was $100, we shock it down to be $85. And second number, 50%, this is the shock parameter for the volatility. So throughout the day, our system calculates for all options, all the Greeks in near real time. On approximately 30-second cycle, we recalculate all options. So we have current implied volatilities throughout the day. So then if portfolio has options, and for each option, we take the current implied volatility, shock it up by this number, then we do full revaluation. So each instrument's value is calculated for what it would be in the event of this shock, and then we calculate the impact on the entire account. So in this case, the first account in the event of this 9/11 type scenario would lose $90,000. And similarly, you can see what would happen to other accounts. These parameters are configurable. You can set them in our back office tool. You can also set parameters of your choice on the fly and ask the system to calculate whatever shock you want immediately. For that, you can click on Add Columns, pick your parameters. For example, I'm interested in minus 30, 25 parallel shock. As soon as I click Add, system will start calculating. You will see that there will be spinning wheel here, and the new column will show up on the right. As soon as it finishes calculating, it will populate that column with values, which it already did. And so like this, you can do ad hoc analysis. You don't need to even go to the back office to configure shocks. You can just add whatever you want on the fly. And then also for each shock, like going back to our original number, this $90,000, that's the impact on the whole account. But if you expand the account, you can see how different positions contribute to the total. So you have a full granularity. You can see exactly how each underlying moved in the event of that shock, and even how each individual position in that underlying moved in that shock. So for example, in NVIDIA, this account has several different option positions. So you can see how each one of them moved in the event of that scenario. Now back to shocks. In addition to parallel scenario with this full flexibility of how you want to set the parameters, we also have three other types of shocks. We have beta adjusted shock. This is an example, volatility adjusted shock, and standard deviation shocks. So in beta adjusted shock, we just move the underlying of each security by that parameter times its own beta. And for volatility adjusted shocks, we move the underlying by this parameter times the ratio of stock's own historical 30-day volatility to market's 30-day historical volatility. So these two shocks are meant to capture idiosyncratic risk, better than the parallel shock. And then finally, the standard deviation shocks. Here, the first parameter, the amount by which we move the underlying, depends on underlying's own standard deviation. So -3 standard deviation 1 means that we calculate 1-day standard deviation and then shock the underlying by 3 times that standard deviation down. Here it's -3, down 3 standard deviations. This shock is the mirror shock up 3 standard deviations. And again, all these parameters are fully customizable. So these risk shocks, they are the core of our system, and then we will show you shortly how they are used to configure risk-based house policies. Before we get there, just a couple of notes. You can do an even deeper dive into risk shocks if you go to our Risk Explorer page. This page looks at one account at a time, but when you request results here, it presents you the full range, let's say not full, very wide range of different market scenarios. So this table at the bottom shows you the outcomes of 80 different market scenarios. The horizontal axis shows the underlying move, vertical axis shows the volatility move, and I chose it to be parallel shocks, and the table shows the P&L, the impact on the account in the event of each shock. And there's also this nice graph, representing the numbers in the table. You can change the step if you want to look at the wider range of outcomes. You can also look add not just a whole portfolio in the account like what we're doing now, but you can hone in on some specific underlying. So for example, how is SPY looking in this portfolio for different range, for this wide range of various market scenarios? This is what it looks like for this portfolio. And then for the risk page, one final word before we switch to margin, we also have this concentration page, which allows you to see all accounts together grouped by symbol. So here you can tell, for example, in Boeing, in the event of the market scenario for all Boeing positions across all of my accounts, what do numbers look like for risk shocks? And here they are. And then you can expand this Boeing and see, okay, which accounts hold it? Oh, these two different accounts hold it. What are their numbers? So this is a very nice page if some symbol is going crazy and you need to quickly see, okay, overall on this symbol, all of my accounts, how does it look like? And then from there on, who holds these positions? Who holds Boeing? What do they look like? Which is the first account I need to deal with? So this is the page where you would be going to answer those questions. So this is about risk. Now let me show you briefly our margin page, and then we'll talk about house policy. So our main margin page sits under credit risk margin monitor. So on this page, you see again the same accounts, 7 accounts with their positions. And you can see in the third column that each account is tagged with the margin type. Here I have some accounts that are active and some that are portfolio margin. This margin type is set on the back office system. And margin type is necessary so that our system knows which methodology to use in margin calculation. So for active accounts, it will use, so margin that we calculate here on this page is maintenance margin calculated throughout the day using current positions, real-time market data. So for active accounts, we use universal spread rule, and this is the numbers that system came up for using that logic. You can see the details of this calculation if you open the drill down window. I will not go further into the details of, how these calculations are made. That's the universal spread rule 2013 methodology. And then for the portfolio margin accounts, the current maintenance margin is displayed in the team's estimate column. So these numbers. So how these numbers, where did they come from? Essentially, we use the OCC team's methodology, but we make a current intraday calculation for real-time prices. So in these calculations, we are not using the OCC file that OCC publishes in the end of the day, those PLRAs file that they distribute around 6 or 7 p.m. We actually calculate our own equivalent of those PLRAs using real-time market data, and then we use the team's methodology, and we come up with these intraday estimates. So these numbers are very useful if you have PM accounts, especially on the days when market move a lot, because it's very difficult to predict what the number will be at the end of the day. This way, you know where you're heading if you monitor these numbers. One way to interpret these results is if market stopped right now and current prices became official close prices, this would be the official end of day regulatory team's margin for those portfolio accounts. So this is our intraday estimate. In addition to that, for portfolio margin accounts, we also calculate the actual regulatory estimate on this page, OCC Teams Reg. Here, you see it says on the top that PM values are calculated using the OCC file from yesterday. So here, our numbers are calculated using the values from the actual OCC file, which makes them the official regulatory numbers. And the value sits here in this column. Everything that I've shown you so far is also available through the API. So some firms for margin, they will use us to monitor things intraday. Some firms will use us to obtain the regulatory end of day calculations, essentially this OCC Teams Reg number. Some firms do both. Now let's switch to house policy. So as Brian was saying earlier, our system allows customers to configure risk-based house policies, and the way it is done is like heavily dependent on those risk shocks, which are the core of this system. So if your firm had a house policy configured on our system, you would see those calculations on the house policy page summary. So if we go here, we will see our 7 accounts. we will see that there is house policy assigned to them called Sterling 2. This house policy is configured on our backend, and I will show you in a moment what it looks like. But this policy is configured. It's not hard. It's not hard coded. It's not a piece of code. It's actually built out of elements that we created on our back office tool, like a very wide range of typical common house policy elements that we see among our large number of clients. We have gradually added it to this builder tool, and now out of these building blocks, customers can create their own custom policies. And typically what we have there is enough for, policies that, let's just say, not too exotic. So many common house policies available on the market, we're actually able to build out of those tools that we created out of those building blocks. For example, Goldman house policy, Apex house policy, we have them configured out of those building blocks that we already created. So this Sterling 2 house policy is a very simple one, and hopefully it will be easy to follow. Let me now show, and so before I show how it looks on the back office, the number of interest for you would be this final house number here. So final house for account number 1, for example, is $208,000. So this is that house margin that is risk-based and is calculated based on the set of rules configured for house policy Sterling 2. So what does this house policy look like? Let's go to our back office, log in, and see where it is configured. On our back office house policy builder page, you see it has a number of pre-configured house policies. We're going to look at the Sterling 2 policy. So as you can see here, this is the high-level building blocks. We are allowed to include the regulatory teams into the house policy. It can be one of the elements that will be considered by the logic. We can include various risk shocks. We can include add-ons to the team's number. We can include add-ons to the risk shocks, and we can include VAR. And how the logic will decide between these different elements is typically either it will take the sum of certain elements or it will take the max of several elements. So in this very simple house policy, we added 3 risk shocks. They're shown here. One is a macro stress. If we open to edit, we see that we have 6 different risk shocks here. They're all parallel. So what the system will do, it will run each one of these shocks on each account. It will see which one of the 6 shocks produces the worst result, and it will pick that shock as the macro stress, the worst macro stress out of the shocks that we specified. Let's look where it is on the GUI. So there is this element macro stress. Here are these numbers. So for the first account, the system tried those 6 different shocks on the entire portfolio and determined that the worst shock would produce the overall loss of $208,000. Then let's look at the next shock. There is concentration shock. So if we open to see what's in there, we see that there are 2 different vol-adjusted shocks, 10.0 and minus 10.25. So what the system will do, it will shock each individual position one by one by these 2 shocks and see for each individual position which shock produces the worst value. And then it will do that for each individual position. So it will come up for each position with the worst outcome between these 2, and then it will compare all positions and it will find the position with the worst number, and that will be the concentration risk. So if you look here, our concentration number is in the column. So for the first account, it is $57,000, second account, $43,000. And then finally, the third type of risk shock we included here is the worst 5. So here we're doing something similar to the concentration risk. Each position is shocked by one of these 4 shocks, and system determines which of these 4 shocks will result in the worst number. But then once it comes up with the worst number for each position, it will take top 5 symbols with the worst outcomes, sum them up, and present that as a worst 5 risk. And you can see that by construction of concentration and worst 5, typically worst 5 here will be always dominating concentration, because the values of the shocks under worst 5 and under concentration are not too different. So typically the sum of 5 will always be higher than the worst one by this logic, but it doesn't have to be that way. You could put in the concentration risk just 1 or 2 shocks, but make them large, make this number large. Then worst 5 will not necessarily always be higher, considering that this worst 5 shocks tend to be lower in the line move. And so then what the system will do here, it calculates these 3 different types of shocks, macro, concentration, and worst 5. And it compares them, which one is the worst, and it also compares them with the OCC TIMSS number, this one. And out of these 3, it will pick the worst one. In my case, the worst one happens to always be one of the 3 risk shocks based numbers. But sometimes, depending on the portfolio, it actually could be that the TIMSS number is worse than any of these 3. Then it would pick the TIMSS for the house policy. Why is it even looking at TIMSS? That's because here we said include TIMSS in the house policy. So essentially it's comparing between regulatory TIMSS and one of these 3 numbers. So this is a really, really, really simple house policy, but it gives you an idea of how these risk shocks can be used to configure this very kind of flexible approach for how you want your house margin to be calculated. The way our real house policies are configured is the same principles, but for example, for the macro stress shock here, some clients will have 100 different shocks, highly granular, like underlying will be moving in 2.5% increments. Because of the non-linearity, you have to look at more points to find the worst one. And then finally here you can look at the details page and you can look at each account, you can see actually for each underline, what was that shock that delivered the macro stress number? What was that shock that delivered the worst concentration number? What were the shocks that delivered the elements of the worst 5? So this is a more granular view. And for the house policies, everything we're showing you is available through API. So this is a very high level overview. I know that we have open a line where we can accept questions. We can answer some questions in the remaining couple of minutes.
Yeah, sounds good. That was great, Tatiana. Thank you.
Thank you.
Again, as Tatiana said, that's just scratching the surface on our system. So there's a whole lot more there. We're happy to do more in-depth demos for you. So if you want, reach out to us and we'd love to do a demo for your firm. I do have a couple quick questions that we'll get to. If you ask the question and we don't get to it, we'll reach out to you directly and make sure we answer it for you here. So first one is, how do I access the system and do I need to download anything? You don't need to download anything. It's a web-based GUI, so you just need your login ID and password, and in any web browser you can access the system. As far as API, we have API docs that we can provide to you and have a full explanation of how to use the API. Another question we have here is, so what option models are employed in the system? So yeah, obviously the devil's in the details. It's important that the calculations are correct and accurate. We use binomial for American options, a 96-step binomial model. We use Black-Scholes for European options and Black for options on futures. And then a kind of a related question is how do you do the volatility shocks in your system? Again, really important to understand how those work. So we use a sticky strike methodology, and then we shock based on that that customizable number that you give us. So for example, if the implied vol of the option is 20 and you do a 20% vol shock, we're going to make the implied vol of that option 24. And we do that for every option in the portfolio and completely revalue your portfolio at each stress point. So again, really important for option portfolios, especially with short data options, zero data expiration options. The Greeks don't always express the true risk in those portfolios, so I think it's important that we have those stress scenarios available to you. Well, thanks everybody so much for attending. Again, it's our first webinar, so we're really excited about it. We plan to do more. We want to cover expiration risk, as that's a really big topic in the marketplace right now. We want to demo our fixed income capability once that's available. And then again, additional Sterling risk and margin features will be coming in the future. So Thank you so much. Appreciate you attending.
Thank you, everyone. We hope you join the next one.